Good day, fellow investors, and we're back to normality, reversal, tariffs. Thus, we are back to the normal risks, and that is also what I want to discuss after this exciting week, because I sense a lot of misconceptions out there. And this is what we do here on this value investing channel. We discuss the risks and the strategies to mitigate those risks, in this case, some kind of hedging. So the market just recovered yesterday, great boom, 9.5% up in a day. Okay, I always love volatility. It was just funny yesterday, just a few hours before Trump changed his mind, Goldman came out saying how the White House is unlikely to quickly reverse most of the new tariffs. Well, half an hour later, everything was reversed, and then even Donald Trump said, we are having a good day in the stock market, as you can see, all-time record day, and hopefully it continues. So Trump intervened to have a good day. When the stock market has a bad day, that's not Trump's fault. When the stock market has a good day, Trump is doing that, of course. That's it with Trump. However, apart the jokes, we need to discuss what's going on, the conviction levels, the strategies, the risk out there when it comes to investing, because we discussed Mark Spitznagel's theory that an 80% crash is out there, and there was a barrage of comments that likely missed my part in the title where I said not yet. And just look at the comments here. How did the 4,000% guy perform outside this one quarter? He did 10,000% during 2009. So that's something we need to discuss, his strategy of holding a negative carry that allows you to be more long, increasing your long-term returns. That is value investing. And then also market timing comments, you become a Peter Schiff. That's not what we do here. We try to increase our long-term returns. Making calls in an environment like this seems absurd, so you listen to a GOAT owner for financial advice, and there was such a barrage of comments. And yes, I respect Mark even more because he has this goat farm. And the comments were there after the market jumped. For 3 days there was radio silence from the bulls. However, this is our little garden, that's a problem. We had some chilly mornings, but fortunately the new spinach is okay. This weekend we collected wild asparagus, today we have some wild garlic to collect and things like that. That is the source and the core, and that's why we can only love Mark even more. But back to business. Comments like this, that my advice has netted negative returns. This is very important to understand. I discuss the risks. Value investing is first and foremost about risk. If I say there is the risk of something happening, I'm not telling you sell your portfolio this or that. I'm just telling you this is the risk. See how your portfolio is structured for those risks. I'm fully invested. I'm just waiting for the markets to open so that I invest more, because I do that on a monthly basis, and the cash I have, I invest it, and I have been invested, and I have performed equally to the market in the last 7 years, 14% per year. The thing that separates me from the market is that I have a P ratio of 10 portfolio, the market 27. If there is 10 years of turmoil, who will do better? And trust me, nobody of us wants to be right, believe me. Not even Spitznagel, nobody. And that's also something that I think comes across. Here is a nice comment from Juan. So, clickbait, crash scenarios. No, we're just discussing the risk and reward. And bear market, everyone was so excited. Sam predicts 65 of the last 3 recessions. I'm not here to predict anything. I discuss the risk and reward, that's it. People have been talking about the debt being the cause of the crash since the 80s. Okay, one time it's enough that it happens and that's it. So the core here, we're not here to predict anything, no recessions. It can happen, it cannot happen, I don't care. I want to invest in a market agnostic way. I want to understand the risk and reward, and I want to do equal or better than the market by taking much less risk. That's the core. Can I do that? I've been doing that for 22 years and I plan to continue to do that for the next 44 years. How? As I said, my P ratio is 10, the market is 27. Since 2017, I did 14, the market did 14. I would be extremely happy if I do 14 for the next decade and the market does 15. Where do I sign? I'm okay with that. The problem is again the risk and reward. The key risk there is the long-term debt cycle, Spitznagel, Ray Dalio. And if you look at that, the long-term debt cycle lasts 75 to 100 years. So not in our lifetime has it, let's say, crashed. The last time was the 1920s, 30s. And if we look at data, this is the debt cycle, so interest rates have been declining for the last 45 years. Thus, this was an environment of 15 years of zero with the expectations that rates will go again lower. Thus, everyone is high on those zero interest rates. The problem is that even the governments are now high on those cheap loans. Everyone is borrowing, and the economy we live in is based on debt. If we look at debt to GDP of the government, it was low, below 40%, then a little bit higher at 60%. This was 60% was usually meant as a sustainable level. Then we had the global financial crisis, 100%, then pandemic 120, and now it is even expected to go higher and higher. However, you can only borrow up to a limit. These are the federal government interest payment expenditures. Those doubled in the last 5 years as interest rates went up. And if we now look at the government budget, you see here net interest is 14% of expenditures. Thus, the deficit is there, 27%, and therefore the government is borrowing to pay interest. That is a Ponzi scheme, that's unsustainable, and that is the key risk. And plus we have tax announcement that's going to increase the deficits even more. And this constant borrowing never worked in history. I'm not predicting it will happen tomorrow, I'm just telling you it never worked. Whether it happens tomorrow, 10 or 20 years from now, it doesn't really matter. It will likely happen. And the solution, the only solution we can have is market agnostic investing. Hence, make eggs no matter what the market does. So you know you'll get your egg. Goats make cheese. And then you have to find other similar investments. Because if not, you are looking ahead of this. If you just invest in the market, this is 20 years, 68% down, 63% down, 15 years, 60% down, 10 years here. And yes, there are these rebounds that make stocks go higher, but that has already happened. And now it is most likely that if a crisis comes, again, you look at minus 60%, and that's not a way to get you retired. The market issues are still there, high valuations, earnings growth exuberance, earnings will not be as high as expected. There are bubble pockets like private equity buying everything at whatever price, government and corporate debts that are used for buybacks at high prices, which is not smart. The solution: we need low valuations to have a market agnostic portfolio. You are rewarded by the dividends, by the earnings, not by stocks going up. Earnings growth, if there is good, if there is not so exuberant, even good. You look fair prices, fair returns being rewarded, and then if you have no debt, it's hard to go bankrupt. And then if you look at the market, yes, the market can continue doing this great returns over the last 10 years, but it might also do this. This is minus 50% from March 2000 to February 2009. I don't know which one of these will happen in the next 10 years. I just know that I want to do good no matter what. And I don't like the minus 50%. There are options like buying value. In the early 2000s, while the market went down 50%, Berkshire went up 54% because it was value. And then here we have one publicly discussed on YouTube, Archer Daniel Midland's one market agnostic, let's say, investments, because you are going to eat. Everything else is pretty risky on that picture for investors. As always, I'm telling you, this channel is not for index investors. Maybe I should put a disclaimer at the beginning of every video so that we say to index investors, shush, we are here for those who want to understand the risks out there and manage those risks affections on portfolio for long-term wealth accumulation. Now let's also discuss the tail risk hedging Spitznagel strategy. He's buying out of the money options with institutional money, where he holds a negative carry of around 2%. So institutions pay him 2% of their long portfolios, and then he makes 100 times their money in 2009, he makes 40 times their money in Q1 of 2020, he will likely have made them some money now, and that increases the long-term returns. They are not down 30% in Q1, they are not down 50% in 2009, because the 2% they paid to Mark Spitznagel was 100, so they were not even down in 2009, which means they just kept going higher as the market rebounded. That is what he does. Thus, it is a positive contribution to all portfolios. And the core there is fat tails, so this is a normal distribution, and then you think, okay, things like that happen only twice in 100 years. The situation is a little bit different. If you look at the S&P 500, 2 times in a century situations, 50% crashes. I have here one, I have here another, I have a 30% crash here, I have a 25% crash here, I have a 20% crash in the last few weeks. That is not reflected in this normal distribution that is used to price options. Those are fat tails. The tails are much fatter, wrongly priced options, and that is how you can buy hedges on the cheap and make protection. That is what Spitznagel does. Just an example, he doesn't likely use the S&P 500, but the June 30 put option at S&P 6,000 points, the price was 13 and it went up to 100 and now crashed to 60 something. This is the volatility, so this is what, 7-8x in just a week. So we'll discuss how investing is about life, so we want to reach those targets for sure. Tomorrow we'll discuss volatility and risk to further deepen on these strategies. Of course, we cannot do fat tail risk hedging because first I would need to be on the computer whole day. I need to go pick my wild garlic now. That's the problem. However, there are other ways to have market agnostic. You accept a little bit more volatility, but over the long term you do okay. Thanks for watching. I'll see you tomorrow.